All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, co-founder of Madison Trading House, Mike Patton. Good morning, Mike.
Hey, good morning, Sip. Good
Today
morning, everyone.
is, today is June 8th, and I feel like the summer doldrums have begun. We're going to continue to talk about the same things, and I'm wondering from your perspective what we're seeing: oil, inflation, unemployment. The looking at the S&P chart this morning, we're kind of in this range, and I really don't know what to expect.
Right. Yeah, and you're not the only one. I mean, none of us seem to know what to expect right now, except lots of question marks. So here's the SPY. We can look back here to May the 27th. And as you can see, we've literally been going in the exact same around 410 to 415 down to 406 or so. I mean, day after day after day, just the same exact thing over and over. Usually, when this happens, it means that there's a lot of things that the market's considering, and a lot of things that we can think about right now are, all right, well, China's starting to reopen, and we've got a lot of policy decisions that were made regarding Ukraine, et cetera, that have already been set in place, and we've got oil prices clearly on a trend. So I think that right now there's just not enough things to push the market in any particular direction. We've already been down quite a bit, but there's not any really bullish news out there. I mean, if you really try, it'd be hard to find any reason why the market should really be up at this point. And we still have some expectations about what type of policy decisions the Fed's going to make. Remember that the next meeting's coming up pretty soon. I don't know the exact date, but within should be within a month at the latest. We should have our next policy, our next meeting to determine the next interest rates. Now, the European Central Bank is going to be deciding theirs today, so that's their first, and then we're going to be coming up later. Of course, ours is more important to us and also to the world, but I think that's one of the things that we're waiting for: which direction economic policy is going to take from here, and then after that, we may get some movement.
Yeah, the EU decision is one of those where it might actually affect the U.S. market, right? Like very rarely, if they do something out of the norm, it could transfer over to the U.S. markets. But yeah, go ahead.
No, so yes, I totally agree. It's I mean, the ECB, massive trading block in the world. I think it is technically it is the largest trading group in the world, that's for sure. And whatever happens there is going to affect us. It has to. A lot of our companies have operations like headquarters located in the EU, et cetera. So there's no way that their decisions won't affect us, and likewise, there's no way our decisions won't affect them.
On the positive front, you did mention that the COVID lockdowns and some of the China lockdowns are easing, which is good for the supply chain.
Yep.
But is it good for oil prices as well, or is the heightened rate of oil going to continue to just increase inflation and make business more difficult for everyone?
Well, great question. And the answer is it depends on who you are. If you're selling oil, it's great. But if you got to use it, it's not so great. So oil producing countries are making a fortune right now. I mean, they're absolutely raking in massive profits. Demand is up much what more than it was the last time we saw prices in this neighborhood. So we're actually seeing, in other words, last time prices were in this neighborhood back in 2008 or so, we had less global demand, so the prices are up, but the amount of purchases of oil would not have been quite as much as what we're seeing now. So that means that more money is being made than before. But in short, it's going to definitely help keep oil prices elevated. I do think a large percentage of what we saw in the slump in oil prices had to do with the COVID breakouts in China. China has gotten it under control, it seems. Now, obviously, they took extreme measures to do it. And in the Western world, we probably would not be willing to accept those sort of measures. I definitely wouldn't. But over there, it's a more authoritarian government. So, therefore, if they say this is what's going to happen, that's what happens. So, I don't think it's over, though, because even with the lockdown where you've dramatically reduced the number of infections, the moment you open up again, it's not like the virus disappeared. And as long as you have people traveling through from other locations, eventually more infections will spread, and then you'll have another repeat of that situation. So unless they truly have stamped it out, meaning that either somehow miraculously they stop the entire virus from spreading, anywhere, which would be very, very difficult to achieve, to say the least. If they vaccinate, which they have, that does put some protection there. But ultimately, I think there's going to be another round of that later in the year, for everybody. So, in short, it's a temporary breather. It's good, but at the same time, I wouldn't count on that being a permanent thing, because I don't think that, as long as their policy is zero COVID, then eventually they're going to have to either lock down again or adopt a different policy. My expectation is that they'll probably lock down again, since they seem to be very determined to maintain the same policy. So that's putting pressure on oil prices as Chinese demand comes up. But that's great for supply chains, like you said, because that means now it's easier to get things out there. And we need that. We absolutely need supply chains to relax a bit. I do think that if supply chain problems ease substantially, that will push down inflation. It has to, because that would eliminate one of the major parts of the price increases that we're seeing. It wouldn't completely eliminate it, but I do think the supply chain issues will actually be more of a factor in lowering costs than the oil prices. But since oil prices are also partially up because of supply issues, I mean, actually mostly because of supply issues versus demand, we need to fix that too. So it's kind of a mixed bag right now. It's hard to say where things are going, except oil prices will most certainly be under pressure to go higher.
Yeah, I think we're all rooting for the supply issues to ease a bit, and
Right.
maybe the war efforts to ease down a little bit too, to lower the pressure on oil. So we'll keep an eye on that. That is keeping everyone else very in tune with the inflation numbers, and it looks like we have a few later on this week that may
Great.
have an impact, right? In CPI, core CPI. Is that's something we should keep an eye on later on this week?
Absolutely. Absolutely. We should, because whatever we see there is going to basically dictate what's next for the Fed. So we know they're watching inflation. We know that's their main target now. And it's ironic because, I noticed that, for example, the OECD, which is the Organization for Economic Cooperation and Development, they've been making some statements, in the press I saw this morning, where they're basically saying, excuse me, that the partial oil ban by the EU, they're basically dismissing it as a possible factor in causing recession. They're basically saying they're not projecting a recession in Europe, which is crazy, because how could we not have a recession at this point? I mean, we already know that a lot of companies financially are struggling to begin with, and then you've got, in most cases, you're seeing a shift in the labor market, where at first it was like you couldn't find anyone, and now it seems like you're losing jobs. So therefore, now people are probably going to have to start looking again after so much time of not having to look. So I think recession is a given at this point, both here and there, and we're already in it. It's just a matter of how much worse it gets. But everyone seems to be, pushing that. Hey, it's not going to happen here. It's not going to happen there. So inflation, I would say yes. We better watch those numbers, because if they come out strong, which they might, I don't know if they should. They probably will or not, but I have to guess they will. If gas prices have been going up like they have, and I've noticed the actual impact. I mean, I don't know about you. Like, I went to the grocery store just yesterday, and I noticed that there's a lot less stuff in the supermarket than I would normally see. And I usually use like Instacart. I usually order that stuff and they have someone deliver it to me. So a lot of times I recently noticed, like, they keep saying like, "Oh, we're out of this, we're out of that." And I'm like, "Man, what's going on?" And then I physically go there. I'm like, "Oh, they're not kidding." Like, a lot of stuff that used to be in ample supply is no longer there. So I can't expect anything other than higher prices. I have to expect inflation to be higher. If they say the numbers are less, I would be suspect of those numbers. I would actually suspect that they're trying to play them down or something. But hopefully that's not the case. But I do think we're going to see higher numbers, and therefore that's going to incentivize the Fed to continue on their course, and that would basically give them a good reason to up the interest rates at a faster, larger pace than what the market wants. So we definitely want to watch that, and also watch the ECB, because the ECB generally has been more lenient as far as their economic policy. They've been more easy lending, et cetera. But I don't think that can last. I think that we're past the point where that can be effective anymore. They have to address the inflation on their own in their own territory, which is crazy right now. It's worse than here in pretty much every measure. So if they don't start to tighten their monetary policy, I don't see how they're going to be able to survive. So my expectation is they're going to start signaling stronger measures to counter inflation, unless they're completely insane. If they're if they're completely insane and they just pretend it's not there, then Europe's in trouble, serious trouble, if they don't address it now.
Yeah, and when you say recession is inevitable, I'm pretty sure the definition is two negative quarters of growth, right? Or
Yeah,
right?
I
And
think it's
and
two. Yeah,
yeah, and so I think we are all on board that that might actually be the case because of
right,
the coming off of the COVID and the amount of money that was put into the market. So we're due for some slowing down, which
right,
hopefully we can withstand it to the point where it's a quarter or two and then start to get our feet on the ground. So we'll
right.
keep an eye on those numbers. We'll see how the market reacts. Um, yeah, and I guess what else do we have in the news? It's kind of been a quiet week other than our community, the Madison Trading House community having a lot of interest and engagement in this Amazon stock split. I know we talked about it in previous episodes. We put a couple clips up online, and the feed, everyone's interested in knowing what to do. The split happened, and now Amazon is trading at $122. And so I guess the question is, what are you seeing? What are your thoughts? Should we keep an eye on anything? Is it time to get in? I mean, coming from what was it, 2,300 last week down to
Yeah,
122. I mean,
yep.
that's pretty compelling for a retail guy.
It is. It is. This will probably be one of the first times that retail guys can actually participate in this stock. And I mean, Amazon's been expensive forever. I mean, if you really think about it, if we went back 10 years, Amazon was trading at what, close to 800 something dollars, $600. I can't remember exactly, but somewhere in that neighborhood. So it's been expensive for a long time. And this has been a very difficult stock for the average guy to trade, the average person to trade. So right now, I would say I expect more people to want to buy. But the thing is, Amazon's fortunes are generally driven by institutions. But with this lower price, we may see a shift. In other words, with the more expensive price, institutional traders are the main players in it every time. I mean, they're the ones that are driving the price because they have the money to do so. And you have maybe some higher net worth people, but they're usually not going to be actively trading. They're just having some advisory firm do it for them. So their money is tied into the institutions as well. So, in short, with the lower price, I do expect more retail participation, but Amazon is not like Tesla. When Tesla was about to split, I mean, Tesla has a celebrity status type of stock. I mean, this is a stock that people like live and die by. You'll see people, wearing Tesla shirts and things like. You don't see anyone wearing a shirt that says, Bezos. No one cares, right? They love Elon, but a typical CEO is not going to have that star power. So I think that Tesla just attracts people, especially retail people, because you see this guy, Elon, who's like, yeah, I'm standing tall. I'm not letting people push me around. I'm building my empire. If you don't like it, I'll move to another state. I mean, he's doing he's playing that American get it done no matter what type of role. And Amazon is just kind of like, well, it's kind of like Walmart. I mean, it's an online. It's just like it's not sexy. It's just not. You use it, I use it, but I mean, it's not that attractive. So I think I have my doubts about whether or not this thing will ever catch fire. I do expect more people to buy it, and I think that the temporary situation is that we had a nice leap in the price because everyone was expecting more action after the split, and we did have some more action after the split, but it does need to get some attention of the regular guy. But once it does, then we should start to see more of that. So I don't know how it will happen, if it will happen, but like I said, there's companies like Tesla where you always have these supporters, believers in the company, hardcore, always stick around, never want to give up kind of people. Amazon just doesn't have that yet. So it's more attractive, it's more usable, but I'm not sure if that's going to translate into a much higher price. So for now, I would say just pay attention to the metrics as a smart retail investor. What you want to do is use the information to your advantage. So we've got our scoring system here, and it's telling me that fundamentally Amazon still is struggling because last quarter they didn't do so well in their report, and their expectations are lower going forwards. But eventually, once I start to see some green showing up on their bottom line, then by all means, now's the time to act. So this will make it much easier to get involved. And this is a company that will be around for a long, long time. They're involved in many different businesses or industries, I should say. So it's no way I can see Amazon disappearing anytime soon. So therefore, this is a good long-term investment for those who are looking for something like that. Just remember that you want to wait for it to really show some good signs. So technically, chart-wise, it's fine. We need some fundamentals to improve on this before we can actually start to buy.
Yeah, and I think we just recently, maybe last month, had the most recent earnings. So we've got a few more months to go before
Right.
we get some more info. I do remember hearing an article that one of their top executives resigned kind of all of a sudden. So
I didn't see that, but yeah, I didn't see what happened. Did they say why?
no, not really, but sometimes when that happens, right,
Yep.
abruptly, maybe their PR team did a good job of covering it up. But that's not what that's not the what the software is for. The software basically is helping us get this broad picture, and
Yep.
if the guy leaves or not, I guess we can dig into that some more. But
Right.
looking at the four score system, right, we got two yellows, one green, one red, and we just have to wait for more information. So I
Right.
hope that everyone that was interested in that Amazon story is willing to sit on the sidelines and wait till we get some more information, because Madison is giving us kind of a holding signal here at the moment.
Right. If we start to see institutions on the inner circle, if they start to buy, now we know that there's some reason to look into it. So as of right now, they're not really doing that. But the moment we really start to see significant increases in institutional buying, now it's time to act because that means they're anticipating something. Maybe it's better earnings, et cetera. So once they move, then we move. But until then, we'll wait. On
Yeah.
a side note, Twitter, before I forget, Twitter is still, just going nowhere. Elon is back and forth about whether he is or is not going to do it. So, for everyone who's been watching this, I will point out that based on where we are right now, price wise, we're exactly where we were before that news hit. We're currently trading at what, 40, 43. When the news hit, we were trading around the exact same place. Then we jumped up and now we're back down. But most likely, Twitter is going to be able to sustain itself in this price range simply because there's not really much reason to sell it. And basically, if the deal goes through, then instantly Twitter's price goes up into the mid 50s, the lower mid 50s. So, in short, if you're interested in holding Twitter, this would probably be the right place and the right time to do it. Obviously, if the markets sell off, Twitter's going to go with it. But all in all, we have a good idea of where uh, buyers were willing to buy Twitter at. So, with that in mind, this is probably the best place, general area to get in. If it's possible to get in lower, definitely we could do so. So, I just recommend to everyone who's a member that if they're interested in Twitter, this is probably the good price range to look at it. And you just have to be willing to hold for months to see what Elon decides to do. But if the deal completely dissipates, the price shouldn't go down much lower than where it is now because we've already been at this price before that deal was ever even mentioned. So therefore, probably this is a good place to look for a buy. So just a side note, and Twitter's fundamentals are neutral, valuation is neutral. Only thing that's negative is the insider, but that makes sense because a lot of people who bought for the deal. Now I had to sell because Elon's back trying to back out. So that makes perfect sense.
Yeah, and who knows what he's trying to do there? Get a cheaper price, find a way to
Right.
break the breakup fee, right? Try and get out of that breakup,
Yeah.
that $1 billion breakup fee.
Yeah, he can get out of it as long as he can prove that they misrepresent the company. That's the only way I've seen it happen. I forget. I got to remember the stock one day, but there was a stock where that happened about 2 years ago, where the merger was already agreed upon, the documents were signed, and everything, and then as they were getting to the closing, the buying company said, "Wait a minute, your numbers don't match up to what you said," and then they sued, and the law has to side with the buyer because the buyer was they were lied to by the company. The company deliberately falsified records, etc. That's what Elon's accusing Twitter of doing, like falsifying the number of users, etc., knowingly. And even if they don't do it knowingly, it still doesn't matter. If you're buying it based on certain metrics and then those metrics are false, still valid reason to back out. So I think the law will be on his side as long as politics don't filter into it. In other words, if politics filter in, then who knows? You may get judges ruling against them, even though they shouldn't. But as long as politics are put aside and they just look strictly at the law, he would have a case if he can prove that the numbers in Twitter are nothing like they say. And of course, you're right. If that was his goal, he just basically obliterated Twitter in one move. So maybe that was his objective, but we'll never know. But either way, it would be interesting to see if he's right.
Yeah, from an advertising perspective, I have been seeing them improving the platform on the back end, updating their audiences, their targeting. So, at the end of the day, that's good for their bottom line as a business, whether, Elon Musk is speaking positively of them or not. When you look at the social media bots, they are still the leader in the number of fake accounts, in my opinion. Facebook has done a wonderful job in cracking down on that. Like we saw in our meeting
Yeah, you're right. Yeah,
yesterday, they're like, please send us an ID to tell us that you're a real person.
yeah, that's good.
Twitter's still not doing that stuff, so there are a lot of fake
Right.
accounts. So if they can get a handle on that, I love the product. I love the potential. It is having an effect on current events with all the elections going on. I know the politicians are out there tweeting and this and that. So the usage is there and they can't figure it out. So we'll keep an eye on it. All right. So moving on, before we go into our, what do we call it? Our pick of the week. I think this might be your pick of the week. I
Yep.
just want to invite anybody that's watching or listening for the first time to get to know the Madison Trading House platform a little bit better. As you can see on the logo on Mike's shirt, on his screen, on our screen, on the dashboard, Madison Trading House is an amazing tool for traders, analysts, stockbrokers, anybody that's really looking at a lot of data and trying to make decisions. It does a wonderful job of bringing it all under one roof and aggregating it to easy to read views to really help you in your analysis. And so, for anybody that's interested in test driving the software for yourself, I'm going to go ahead and add a link into the chat. Also, feel free to leave any comments, hit the like, hit the subscribe, hit the follow button. We do appreciate providing content. If you have any specific stocks that you want Mike to run through the software, leave them in the chat and we'll see if we can get to them. But with that being said, the stock pick of the week that you have is one that is new to me, but they have a very interesting ticker symbol, and that is LOVE, aka Love.
Yeah, yeah, and it's actually new to me too. I've seen these commercials for this company, Lovesac. I've seen them on TV and online, and they are interesting commercials. I'll put it as that. But I didn't really recognize the brand until I saw the stock. So it showed up on the scanner for all green. So we got green technical, green inner circle, green valuation, green fundamentals. Everything on this stock is green, 100% green. Now they just had earnings. So if you look at the chart here on my screen under the technical window, you can see that it dropped down. So earnings just came out yesterday, and basically The stock dropped. But the thing is, the earnings weren't bad. The market was expecting them to lose, let's see, 20 cents per share. They actually had a gain of 12 shares. So for those of you who are not familiar with earnings, an earnings report basically says how much money the company made during the last quarter on a per share basis. So if a company made $1 million and they have a million shares, then they made $1 per share. That's basically what it means. So they made 12 cents per share when you look at their total revenue, to total, sorry, net earnings, their actual profit versus the number of shares. But the market was expecting a loss. So that's a good sign. They actually did positive rather than negative. The other thing is that this does compare slightly less than what they did the same time last year. Now, last year for the same reporting quarter, they actually were at 13 cents a share. So they dropped a penny. Now, a penny may not seem like a big deal, but in the big world of companies, 1 cent over a large number of shares means a lot, right? So you have to think about that way. But considering the overhead costs, considering the supply chain issues, labor costs, et cetera, that a company is dealing with now, which are definitely a lot higher than what they were last year. I mean, oil prices basically are double what they were last year around this time. So we have to admit that if they only lost a penny per share, they're not doing so bad. Their actual sales revenue went up. 129.38 million for the quarter ended April 2022. That's surpassing the consensus estimate by 12.07%. So revenue just means the gross amount of money that was brought in, and then of course you have to convert it into a profit when you deduct all your expenses. But revenue is a key metric in determining if a company has growth potential. If it doesn't have continually growing revenues, then it's not likely to be a good company. All growth stocks have that in common. They have constantly growing revenue. That's why investors are attracted to these sort of stocks. I'll show you the revenue stream in a second, what it looks like for this stock. But keep in mind, again, it's 12.07% greater revenue than what the market anticipated. And it compares to last year, this time, they had 82.92 million. So they crushed their revenues from last year. So this is showing great growth, but the only reason they can't convert it into profits is because costs are up, right? So even with that great improvement in revenue, they still could not improve overall their profits by more than they weren't able to improve their profits from last year compared to last year because of the expenses. And that's one of the reasons I believe the market was expecting a loss because they were expecting they couldn't hit this sort of revenue goal gain, but they did. So this looks very attractive. And if I look at this stock on a fundamental basis, this is what its sales growth looks like. You can see that clear pattern of continuing incline. And notice that it gets sharper on the incline as you go farther to the right. And what that means is that the rate at which they're gaining sales, they're expanding their market share, is increasing every quarter. So if that's the case, and it is, then that means that wow, you got a company that's actually doing pretty well. If I look at the sorry, down here, if I look at the net income, you can see it's growing. Their net income is actually up 31.28%. That's their net profit, up 31.28% from where it was 12 months ago. So these bars represent the last 12 months of activity. And basically, what it's just saying is that, well, from the last quarter, I should say, the last 12 months quarter reading, which was this previous bar, we have an increase of 31.28%, basically. So, in short, this is impressive. Like they're doing really well. And if we look at the analyst targets over here on the right, analysts universally believe that this company is going to be gaining value. The median estimate is that this company will be worth about $107.86 a share sometime in the next 12 months or so. The lowest estimate is 95, the highest is 124. Now, granted, this is not a stock that's being analyzed by a lot of people, but it has, I believe, at least 7 analysts, major analysts that are looking at it, and their opinions of it are pretty positive. As it continues to grow as a company, you'll get more and more analysts analyzing it, so their opinions may be a little different, but nevertheless, we can definitely see here is the earnings history from 2019. They posted an expected loss. They didn't actually post any profits, I guess, but here in 2020, they basically matched up to expectations. 2021, they beat them. That's why you have this line in the middle, which is telling us the actual outcome of earnings versus the shading in the background, which is showing us what was expected. So every time the line in the middle is taller than the shading in the background, it means you beat estimates. So they crushed them in 2021. They beat estimates so far. Their fiscal quarter ends in January 2022, so that's why it says that down there. So their last fiscal year, I meant to say, ended in 2020, January 2022. They beat estimates there. This year, which will include now going up until January of next year, the expectation is that they're going to beat by a wide margin the revenues and sales and earnings that they did this year, this last ending year, fiscal year, and the next one is expected to. So this is looking like a good opportunity. And given that the stock is not trading at time highs, I do think this is an attractive time to look at getting into this stock. I mean, if we look at it here, it's basically trading towards the lower end of the range it's been in since 2020. So I do think this is due for somewhat of a rally, and with the numbers that just came out, most likely this is an attractive point to buy. So I'm definitely casting my lot in for this one. I do think it's a good opportunity. We'll see if it does pan out, but I'll definitely be putting this one out as an alert for everyone that's in the service.
Yeah, that's an awesome find. And can you go back to the analyst forecast real quick?
Sure.
I just want to double check the low end of the forecast is
$95. I mean, you never
that
know if they're going to be right or wrong, but my point is if they're half right, you're winning on this one, right?
that's a 3x guess, right?
Yeah.
And I think all the fundamentals are there, and the product is really cool. Like I keep going through,
Yep.
right? I keep, I keep looking at this little bad boy, this little love sack right here, and I could imagine this in my living room.
Right. I mean, we were just looking at that. So, folks, we're not kidding. Before the podcast, we're looking at these and saying, man, they're like $300, $400 each. So these are reasonable prices, all things considered, and I mean, they look very comfortable. We don't work for Lovesack, but I would definitely say you'll probably see one of these in my living room pretty soon.
And we got to be honest, that's a great ticker to pick up, right?
Yeah.
LOVE, right?
Yeah.
Surprised no one else jumped on that before Love Sacking Company.
Yeah, actually, I'm surprised too, because Southwest got LUV. I don't know why no one else had love, but yeah, it's amazing, right? But it's a memorable ticker. Everyone's going to remember that one. So there you go.
Yeah, and once again, this is the power of the Madison Trading House software is to be able to create these scans, these parameters, let it run every day, and then it find these potential winners, do some extra analysis, and everything you just went over, Mike. I just pulled up the option chain, and I'm like, oh man, this is like I'm liking this for the next 6 to 12 months here.
Agreed.
And so putting it on the radar. So anybody watching, listening, Mike Patton, Madison Trading House called it first here, LOVE for the win.
Yeah, and hopefully it follows through the way we expect. So yeah, looking like a decent opportunity for sure.
Awesome. I think everyone watching should appreciate that. All right. Heading into the last leg of the show here. I know our last episode we went over the charting of the score, which is that little color spec that you have below the chart. So if anybody wants to get a quick review of that, um, I'll go ahead and try and drop the video in the chat, but it is on our YouTube page and on our Facebook page. Um, do we want to go over the comparing multiple stocks on a chart? Is that today's
Yes.
lesson?
Yes, it is. So fundamentals and technicals on an individual stock are one thing, but when you want to actually get a sense for how a stock performs in general compared to, let's say, the rest of the market, then we can actually do comparison. So I'm going to click this little button up here. I'm looking at love at the moment. So notice that I have some common comparisons, or I can actually select a symbol that I choose. I could choose a stock if I want. If I want to look at how does Twitter compare to Lovesack, I can put Twitter in there. But let me just show you something more basic. So I'm going to go to the Spider SPY. So that's the ETF, the exchange traded fund that tracks the S&P 500's value. They just have it in a tradable way, like you can trade it in shares. And then look at the Vanguard Russell 2000 Index Fund, which, as the name implies, is a fund that is tradable, and it's based on the Russell 2000 Index. So here we go. I got both of these there. I'm going to hit compare. Now I got the lines. Now the lines are as follows. Love is the blue one, or kind of bluish chalky purple. I'm not sure what color that is, but violet. Yeah, that's the color. The violet colored line is this one. The SPY is the red line down below, and VTWO is the Russell Vanguard Russell ETF. That's the green line. Now these are not scaled based upon price. This is the cool part. If you were wondering, like, how come Love is priced higher and it's $33, but the SPY is like $400 and some and change? So why is this one up? Well, it's up because this is scaling based on percentile. So it's actually showing what percentage gains we've seen. So if you look above, like right here, right, and also right here, and also over there. As I move my mouse from left to right, you can actually see the percentage gain from the starting point, which is over here. Okay, so I've got it looking at it looks back 3 years roughly. Um, so basically, we're looking at what's been happening since 2022. So, in short, as we look at the performance over time, we can see that Love really did reach a peak up here. This was in June of 2021. They were up 341.5% from where they started back here in roughly June of 2020. So there was a pretty large gain there in 1 year. Now, in the SPY in comparison, that was up 39.48%. The Russell was up 68.36%. So, of course, those are good numbers in all of these, but obviously, um, Love gained a lot more. Now, since then, Love has come down for a variety of reasons, but as it stands right now, it's back into a pretty fundamental picture. There are definitely always going to be concerns about supply chains and things like that. But what I'm getting at is, if we look at it relatively speaking, notice that Love starts off, we all start off at zero. When it gets down to its performance being comparable to the indexes, then you get a run. Then it comes down to the same performance as the indexes, then you get another run. And guess where we are now? We're right back there again. So we had a quick bump after, then it came down again. But notice this is based on percentages. In other words, once Love comes down to whatever the market is at, whatever performance the market is at. So if the market's up 30%, and let's say Love was up 70%, then it comes down to being up 30%. It's exactly there where we typically see the buyers come in. Now, I wouldn't be able to know that unless I have this in front of me. So most of the time when I try to compare stocks, most platforms that I used in the past before we made, before the Madison platform existed, they don't give you this sort of comparison. So it makes it harder for you to figure out what's going on. So it's by showing it in this format, I can easily detect places where value will likely come in. In other words, this is a stock that has so much bullish interest that whenever it gets to market value, basically, where it's in line with what the rest of the market's doing, it's just usually a matter of time before it takes off again. So we're looking like we're right at that point now. Earnings did pull us downwards a bit, right? So we went up at first before the earnings, then we had a slump. But all in all, I think that this overall point that we're in now puts us in a good position for us to look for a further value up. So doesn't mean it's going to go up right away, but it does mean more than likely it has the potential to outperform the rest of the market from where it is now.
And question on the layering, how many different symbols can you put on there?
I don't know if we actually have a limit. The programmers, we didn't tell them to put a limit on there, so let's see. Let's just throw everything on there and see what happens. Well, there they are. Um, but clearly, like for example, gold doesn't seem to have any strong relationship, but we can clearly see that. Let's get rid of gold for a second. But if we look at all these other indexes, once we have these consolidation points where performance, and remember, when I say performance, guys, just remember I'm talking about percentage gain from the start of the chart. So the markets are going up, and every time this one comes back down to where it's matching up the performance to the market, it doesn't tend to go under it. It tends to get to it and then go right back to higher performance. So it looks like what the market's basically doing is they're buying in this stock anytime it's at a relative value point compared to the rest of the market, and they keep buying. And then eventually, the bigger players they probably start to sell as smaller players get in and buy late. So if we can catch it early, we can be one of the people selling later on, and we can do this for any stock. So we're looking at Love right now, but let's look at ConocoPhillips. Okay, so here's Conoco. Now, I want you to notice this is ConocoPhillips, the the lineup above, and notice for a while its performance was right in line with the rest of the market. Not a really big discrepancy there between what the rest of the markets were doing. So we're looking at the SPY, the Dow Jones, the Nasdaq, and the Russell 2000, which were the big indexes. We're just basically treading along, no big deal. But then all of a sudden, right here, and this is in 2022, um, we start to branch off. And as we go forwards, the distance gets larger and larger and larger and larger and larger until finally we get up to here. ConocoPhillips has gained 60. Let's see right here where my mouse is. ConocoPhillips has gained plus 65.58%. The Dow Jones looks like we're looking at 6 months here. The Dow Jones is down 7.21%. The S&P is down 11.45%. The Nasdaq is down 22.46%. The Russell's down 15.57%. But ConocoPhillips is way up there. So this is a stock that doesn't since it's not a since Conoco is an oil stock, logically its fortunes are going to be tied to oil. So if oil's doing well, Conoco should. But let's actually prove that. Okay, let me get rid of all of these other indexes for a second except for the S&P. Okay, and let's add another symbol. Let's add actually let's see, let me delete these. I was hitting backspace to get rid of them. So put in USO. USO is an oil fund. And look at that. USO is the purple one. Notice the clear correlation, right? So this proves my point. So if you ever were wondering, like, I wonder if this stock, there you go. You can
Yeah.
see exactly how well it correlates. Now, this is a more advanced idea, but I want you guys to understand that this gives you power. This gives you the ability to realize when you might be at a good place to buy a stock. Most stocks will perform relatively the same as the rest of the market a lot of the time. But when you find a stock that can consistently beat the market, when it comes back to matching the market, it's a lot of times that you'll see those stocks start to outperform again. So once you know they're at that point, you can actually jump in where everyone else is wondering why you got in, right? And of course, the software will be able to find exactly when the stock has got the right profile, when it has the right fundamentals, technicals, etc. Once it happens, it shows up on the radar, and then we can quickly compare it on the chart and know exactly what to expect.
Yeah, I think this is a very unique offering that a lot of the other charting softwares do not provide the ability to layer the performance of different stocks, different sectors, comparable sectors, etc. So I do think this is a very unique part of the software, in addition to all the other amazing features of the Madison Trading House platform. So once again, if anybody's watching, listening for the first time, and you're interested in taking a deep dive into the software for yourself, feel free to hit that link in the chat, sign up for a free demo, and we'll get you on your way. With that being said, we're going to go ahead and wrap the show down here a bit. Mike, appreciate all the insights. We're going to be
Awesome.
keeping an eye on inflation this week. It is kind of, things are beginning to slow down. But I do encourage everyone to check out that LOV trade. I think it might be one of the best ones we've done so far. So
Yeah.
we'll keep an eye on that. In addition, if anyone wants Mike and the team to go over a specific stock, etc., drop it in the chat. We'll see if we can get it into the show. Or if you have any specific questions about the software, the capabilities, feel free to leave a comment as well, and the team will get back to you as soon as possible. Mike, anything else we should be keeping an eye on heading into? I mean, we're midweek here. Midweek, first week, second week in June, first week, second week in June.
Well, other than the weather, I think we covered it all. So I think we're good for now. So yeah, just keep an eye on the inflation data, and definitely, guys, look at love. And if you buy a love seat there, just be sure to let them know where you found them. Okay, they might actually give us a nice love seat for our efforts. Okay.
Yeah, we'll hit them with the email and say we promoted the brand. See if if you can get a nice little love sack there behind you.
Sounds good.
All right, everyone. Thank you for your time. We'll catch you next week. Appreciate it, Mike. Appreciate it. Have a good afternoon, everyone. Take care. Good luck trading.
Take care, folks.